Hello everyone and welcome back to my home office. Today we're going to talk about adjusting entries. Adjusting entries occur at the end of a period, usually the end of a year. Adjusting entries are required by the accounting period concept. The accounting period concept states that we have to report revenues and expenses in the period in which they actually occurred. In other words, we report them when they actually happened, not when cash was exchanged. That's entirely different sometimes. It can be the same, but not always. You have to look at when the event took place. Now, also, adjusting entries must be done before we can do financial statements. Now, you may see in your book something called an unadjusted trial balance and an adjusted trial balance. An unadjusted trial balance is a trial balance before the adjusting entries have been done. The adjusted trial balance is the trial balance after the adjusting entries have been done, and after you do the adjusted trial balance, you can then do your financial statements. You cannot do your financial statements without doing your adjusting entries. Now, hopefully I can get this visual in the screen, but adjusting entries basically fall into two categories. The first, the one that you see in red, is that cash has already been exchanged. In other words, in a previous entry, it involved cash, and hence now we're adjusting later. I'll explain more about that. The other one is cash has not yet been exchanged. What that means is that there has been no previous transaction and no cash is yet to be exchanged, but cash will be exchanged in the future, but the events have already occurred. I'll get more into that in a little bit. Now, one thing I want to note here. You hear all this mention of cash. When you're doing adjusting entries, you never do an adjusting entry that involves cash ever. Let me say that again. You never do an adjusting entry that involves cash ever. If you do, you're wrong. Okay, there simply are none that involve cash. Cash will never be an adjusting entry. Now, in the first category I mentioned, was that cash has already been exchanged, which again means that there was a prior transaction that involved cash. Well, generally I break this down into two different types, really. I'm going to have prepaid expenses is one, and then the other one is unearned revenue. I'll start with prepaid expenses though. Prepaid expenses are really the most common one that you'll see, and you've probably already experienced part of this actually in your class. There are basically three kinds of adjusting entries relating to prepaid expenses, depending on your textbook. Some only have two. The first one is traditional prepaid expenses, like for example dealing with prepaid insurance. The second one is supplies, which works a lot like a prepaid insurance. And the third one is depreciation expense. Depending on your textbook, they may put that into a separate category, or they may put it in with prepaid expenses. I just put it here just because it's easier on my end. Now, for prepaid expenses, basically you're adjusting for amounts. Now, this is back to prepaid expenses. You're adjusting for amounts of the prepaid expense that you have used. The most common one is insurance. Now you should have actually already done an entry that goes, for example, that you purchased 12 months of insurance, for example, for $1,200. So if on September 1st you purchased insurance for $1,200, you probably did an entry that looked like that, okay, where you debited prepaid insurance and you credited cash. Well, that's in September. December 31st comes up. You have to adjust for the amount that you've used. So, you take a look. Well, how many months has it been? This is where people commonly make a mistake. September, October, November, December. 4 months, not 3, okay? Now, the adjusting entry for that would look like this. You would debit insurance expense, hence you expense the amount that you have used, and then you would credit prepaid insurance to lower prepaid insurance. Hey, for the amount that you've used. And you can see my math on the bottom. Okay. Now, the next one that I have is supplies. Supplies works pretty similar to prepaid insurance, except for that when people buy supplies, they basically will buy a bulk of them, and then they'll just keep track of all their purchases throughout the year. Then at the end of the year, they count how much they have left, and the difference is the amount that they have used. And the amount that they have used is how much they have to adjust by. So, for example, if a company buys $1,000 of supplies on October 1st, okay, no big deal. If that happens, you're doing a journal entry that looks like this one. October 1st, I'm going to debit supplies for $1,000, and I'm going to credit cash for $1,000. Now, December 31st rolls up. Somebody goes into the supply room and does a hand count. Well, it turns out that, they only have, say, $600 of supplies remaining. Well, they started with 1,000. They have 600 left. That means if you subtract them, that they used up $400 of supplies. This is all based on a hand count. So you would have an adjusting entry where you would debit supplies expense, hence, like prepaid, you're expensing the amount that you have used, and you will credit the supplies account to lower it to get it to the amount that you actually have now. So that is supplies. Now, the next one I'm going to mention, as I said before, some textbook puts this in prepaid expenses, some give it its own category. I kind of actually agree with giving its own category, but anyway, depreciation. Now, depreciation is kind of what I like about depreciation expense is that the format of the journal entry is always the same. This makes it easy to remember. In fact, if you take a look at the format, you're always going to debit depreciation expense, and you're always going to credit accumulated depreciation, always. Now, here's the thing, though. How do you calculate it? That's for another chapter. It's not great. That's actually later on in the book. But let's just say, for example, you get a question that says, well, we have to accrue for $500 of depreciation expense. That's how much has been used. Well, I would do an adjusting entry where I simply debit depreciation expense for $500 and credit accumulated depreciation. Now take a second look at this, and now see how it fits the format? It's pretty much straightforward. Now all of these prepaid expense category ones, a prepaid expense is the supplies and the depreciation expense, depending on how you look at it. They will all actually debit an expense account. That's one thing they all have in common. The other thing, they all credit an asset account. Now you may be thinking, wait a minute. Accumulated depreciation, is that really an asset account? Yes, it's a contra asset account. Now the other ones where you credited supplies or you credited prepaid insurance, those are traditional asset accounts. But again, for prepaid, you're going to debit an expense and credit an asset account. Now, next, and much less extensive, is unearned revenue. And unearned revenues you probably have seen before is revenue basically that you haven't earned yet. In other words, somebody pays you in advance. So hence a company receives money in advance, but they haven't performed any services to earn that revenue. Now, as you perform the services, you need to adjust for the amount that you've earned. Sometimes people don't do this to the end of the year. Sometimes you'll see, for example, you have a company like Merry Maids where you'll pay for 4 months of service at a time. And hence, every month they can adjust. Well, let's just say, for example, that on October 1st, a company received a payment of $4,000 for 4 months of services. Well, what exactly are we going to do with that? Well, at the end of the year, you're going to have to adjust for the 3 months of services used. So hence, for unearned revenue, you will need to debit unearned revenue, and then credit service revenue. So what you're doing is with unearned revenue, you're debiting it because you're lowering that account because now you have earned it. And you put it in service revenue, some books fees earned, but same thing, because you have now earned that revenue. So hence we're taking it out of unearned revenue and putting it into an earned revenue account. Now what this one has, by the way, also, count these unearned revenue types, you're always going to debit a liability and you're always going to credit a revenue type account. Always. Now, the next category, cash has not yet been exchanged. And you can see here, cash has not yet been exchanged. And really, we're going to have two types of accruals. We're going to have to accrue for revenue, and we're going to have to accrue for expenses. Now keep in mind, cash has not yet been exchanged, so hence there was no previous entry, so that's why you're accruing for it. Accruing for revenue, for example, is having done the work, but you haven't sent them a bill yet. Now, for example, me as a CPA, I do a lot of bookkeeping for people, and sure enough, the end of the year rolls around. You know, the holidays get me busy. I don't always get a chance to send out to people a bill. But let's just say, you know, at the end of the year, you know, somebody owes me about $2,000 of work, and I haven't sent them a bill. But I have earned revenue. Even though I haven't billed them yet, I have earned revenue. Even though cash has not been exchanged, I have earned revenue. So I have to take that into account. So if I have earned $2,000 of revenue that I have yet to bill for, I will need to then debit accounts receivable because it's money I am going to get in the future, and I will credit revenue because I have earned revenue. Again, I will debit accounts receivable and I will credit revenue. What's interesting about this type is you will always debit an asset and you will always credit a revenue type. Always. So, now, our last one to mention, accrued expenses. Accrued expenses are expenses that haven't been incurred but haven't been paid yet. Probably the most common one of these is payroll. You may be thinking, well, how can payroll be that way? Well, I'll ask you this. Have you ever had a job where on December 31st, you walk out and they pay you up to the minute, to the second you leave, in cash in your hand? I doubt there's anybody out there who's ever had that happen. So what you have to do is accrue for that payroll that the employee has earned, which is an expense to the business, but has not been paid. So in other words, you have payroll expense that you have yet to pay. You're going to pay it the next year whenever, paychecks go out. So how do we do with this? Well, let's just say, for example, that, on December 31st, there's an employee that you owe $300 to for work. And obviously they haven't been paid. Well, on December 31st, I would debit wage expense and I would credit wages payable. Again, I would debit wage expense and credit wages payable. The thing about accrued expenses is you're always going to debit an expense and you're always going to credit a liability. Always. Now, I know that seemed kind of long a little bit. I said it would be brief, but there's quite a bit to adjusting entries. One thing to remember, you'll also see closing entries. That is entirely different than adjusting entries. So, that's all I have to say. See you later.